D.R. Horton, Inc., stock ticker DHI, is an American home construction company. Founded in 1978, D.R. Horton is now a $38 billion market cap home building major that employs more than 13,000 people. By volume, D.R. Horton is the largest home builder in the United States. There are three key factors that make D.R. Horton really appealing for long-term investment. First, there's a structural and favorable imbalance between supply and demand. It's been estimated that the U.S. has a supply deficit of around 6 million homes. For many years and for many reasons, annual U.S. home production has been consistently coming up woefully short of what's necessary to meet demand. This large gap between what the market demands and what's being brought to market is a long-term tailwind for D.R. Horton. Even if new home construction suddenly starts to come up in a meaningful way, it'll take many years of overproduction just to close the existing gap. Second, D.R. Horton has scale in an industry where scale is practically necessary. Building homes is extremely capital intensive, and D.R. Horton's status as the 800-pound gorilla gives it the financial wherewithal to aggressively compete through the cycles. This is a very difficult industry for new entrants as the capital requirements are very high. Third, D.R. Horton is catering to the appropriate area of the market. See, the company focuses on first-time home buyers looking for value. Just under 70% of its homes were sold over the last year at a price of less than $400,000. This area of the market is where the greatest imbalance between supply and demand can be found, as there's a constant stream of young adults trying to form households at affordable price points. Because of all of this, D.R. Horton has had a magnificent run since the bottoming out of the U.S. housing market post-GFC. The company's stock is up more than 450% over the last decade alone, supported by rapid growth and improving fundamentals across the business. While the U.S. housing market will undoubtedly be prone to booms and busts in the future, a combination of scale, supply shortages, and targeted construction all bode well for D.R. Horton. And it's why I think the company's revenue, profit, and dividend should continue to rise for years to come. Already, the company has increased its dividend for 9 consecutive years. The 5-year dividend growth rate of 16.8% just goes to show what a fast start D.R. Horton is off to. And I haven't seen much of a slowdown here, as recent dividend raises have been in the double digits. Now, one can never expect a high yield when you get this much growth. There's almost always a trade-off to make on the other side or the other. Indeed, to that point, the stock's yield is just 0.9%. That is close to the stock's own 5-year average yield, and with the payout ratio sitting at just 7.1%, which is incredibly low, this is a very safe dividend that is set for much more growth ahead. Income-oriented investors looking for big dividend payments today, even if those big dividend payments come at the expense of total return over the long run, probably won't be attracted to something like D.R. Horton. However, for long-term dividend growth investors who are looking for lots of growth and outstanding long-term total return, it's compelling. Looking at business growth, D.R. Horton escalated its revenue from $6.3 billion in fiscal year 2013 to $33.5 billion in fiscal year 2022. That's a compound annual growth rate of 20.4%. Wow, stunning revenue growth here. Many tech companies out there would love to grow the top line this fast. Meanwhile, earnings per share grew from $1.33 to $16.51 over this period, which is a compound annual growth rate of 32.3%. Remarkable. Most of the excess bottom line growth has been fueled by steady margin expansion, which has been breathtaking. Put simply, D.R. Horton is growing faster than almost any other business I know of. One might not automatically associate a home builder with a high growth rate like this, but that's exactly what you have here. The big question, of course, is will it continue? Looking forward, CFRA is forecasting a 5% compound annual growth rate in D.R. Horton's earnings per share over the next 3 years. CFRA seems to be answering the question with a resounding no. I wouldn't expect D.R. Horton to put up world-beating numbers for decades on end. However, CFRA's projection could be a bit too dour, and it almost seems at odds with CFRA's otherwise glowing review of the business. For example, CFRA states, and I quote, "Despite high mortgage rates, D.R. Horton has benefited from a tight existing home market, leading primarily entry-level homebuyers to engage in home building transactions. Expectations of cooling demand continue to be tested by incoming data suggesting higher mortgage rates for longer. So far, the consumer remains resilient, and we expect the recent uptick in home prices impacting affordability to be offset by falling mortgage rates through 2024. As a larger home builder, we expect D.R. Horton to benefit from scale and see it favorably positioned to incentivize transactions in a slowing economy. economy, unquote. I think CFRA keyed in on an important point here. The rapid rise in mortgage rates caused a lot of pundits to call for a drastic fall in home sales and prices, yet that hasn't happened at all. Why? Well, I think it comes down to the point made earlier on tight supply, which CFRA reiterated in the quoted passage. I'll also note that D.R. Horton is currently working through a backlog worth over $7 billion before new orders are even accounted for. The last decade was really special for D.R. Horton, and I don't see it as something that an investor can put forth as a realistic baseline for future growth expectations. Moreover, the next few years could work out similarly to what CFRA is putting forth. However, the long-term market dynamics work strongly in D.R. Horton's favor, as a massive supply deficit is a years-long tailwind for home building. With the payout ratio sitting below 10%, D.R. Horton could actually have flat earnings for the next few years and still pump out low double-digit dividend growth. That said, the growth forecast being posed above isn't flat, which only gives D.R. Horton even more dividend growth firepower. Overall, I would be surprised to see D.R. Horton deliver anything but low double-digit dividend growth over the next few years, although I think that will settle down into a high single-digit range at some point thereafter. Moving over to the balance sheet, D.R. Horton has a fantastic financial position. The long-term debt-to-equity ratio is 0.3, while the interest coverage ratio is nearly 50. Moreover, the company's cash position is healthy. Profitability is outstanding. Net margin has averaged 12.9% over the last 5 years, while return on equity has averaged 24.9%. D.R. Horton's returns on capital are up there with some of the world's best businesses. I can see why Warren Buffett's firm recently bought shares in this home builder. Fundamentally speaking, D.R. Horton is very impressive, and with economies of scale, barriers to entry, leading market share, and industry know-how, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The housing industry is notoriously cyclical and sensitive to overall economic trends. There is direct exposure to interest rates, as interest rates affect demand for mortgages and housing. Building homes is a capital-intensive activity, and D.R. Horton must continuously manage its inventory properly. Input costs are a serious consideration, and inflation is causing upward pressure on these costs. D.R. Horton's catering to first-time entry-level homebuyers makes the business especially sensitive to overall economic health. Labor has recently been tight in the U.S., and any labor shortages could severely curtail production. These risks should be carefully thought over. However, the stock's valuation after a recent 50% slide in price looks attractive and should also be carefully thought over. The stock is currently trading hands for a PE ratio of 8.1. That obviously compares extremely favorably to the broader market's earnings multiple. That said, this is a stock that often gets little respect when it comes to multiples. Its own 5-year average price-earnings ratio is only 9.3. That is absurdly low for a business that's been growing this fast. Of course, this combination of a low valuation and a high growth rate is what has led to a remarkable total return over the last 10 years. Also, the yield, as noted earlier, is close to its own recent historical average. I valued shares using a two-stage dividend discount model analysis. I factored in a 10% discount rate, a dividend growth rate of 16% over the next decade, and a long-term dividend growth rate of 8%. This near-term dividend growth rate might look aggressive at first glance. However, it's actually lower than D.R. Horton's demonstrated dividend growth over the last 5 years. Furthermore, the payout ratio here is under 10%, giving the business tremendous flexibility on the dividend, even in the face of a possible slowdown in bottom-line growth. I mean, the dividend could double tomorrow and still be easily covered. I'm basically assuming that D.R. Horton will continue to pump out dividend growth that is in line with what it's been pumping out already for a number of years now. Because of major U.S. housing supply shortcomings, I really don't see the bottom falling out here. That's evidenced by demand holding up in the face of the fastest rise in interest rates in U.S. history. On the other hand, I'm also not modeling in any kind of growth acceleration, which I see as a down-the-middle compromise. The dividend discount model analysis gives me a fair value of $105.39. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value value dividend growth stocks. Morningstar rates DHI as a 3-star stock with a fair value estimate of $122. CFR rates DHI as a 4-star buy with a 12-month target price of $145. Surprisingly, I came out very low here. Averaging the three numbers out gives us a final valuation of $124.13, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. D.R. Horton, Inc. is a high-quality, industry-leading business that features high returns on capital, rapid growth, and a stellar balance sheet. Its industry is notoriously cyclical, but supply shortages and firm demand are evidentiary of a favorable change. With a double-digit dividend growth rate, an acceptable yield, an extremely low payout ratio, nearly 10 consecutive years of dividend increases, and the potential that shares are 9% undervalued, this could be a chance to follow Warren Buffett's firm into a great long-term investment. And now for a special news announcement. General Mills Inc., stock ticker GIS, just reported pretty solid Q1 numbers, matching top-line estimates and beating on the bottom line. Guidance for the year is calling for adjusted diluted EPS to increase 4% to 6% in constant currency. Not huge, but not terrible for a mature consumer staple. The stock yields 3.6% and carries an undemanding earnings multiple of 15.3. Take a look. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.